Well, we start off tonight's show with a look at Africa's currencies. And of course, they have not been spared as the US dollar batters global currencies. The Kenyan shilling has plunged to an all-time low of 120 shillings against the dollar, while South Africa's rand slumped to 18.11 on Monday, which is a 28-month low. Now, it closed Tuesday slightly firmer at 18.09 rand per dollar. Meanwhile, Nigeria's Naira is trading at 436.5 to the dollar, but on the parallel market, the currency has fallen to 750 Naira per dollar, leaving a gap of about 65%, which is the widest since 2016, and that's according to Bloomberg data. Now, across the pond in Ghana, the cedi has fallen 39% against the dollar since January, and it is currently trading at 10.35 cedis per dollar. The black market in Accra offers better rates, leading the government to now crack down on parallel traders in order to preempt further depreciation. In Egypt, the situation is no different, with the pound trading at a low of 19.49 units per dollar. The West African franc, the CFA, which is used in French-speaking West African nations, is trading at a low of 683.87 CFA to the dollar. And that, of course, is as a result of the euro. Now, of course, the weakening currencies pile on inflationary pressures in these various nations. But what is causing this slide? Let's get into all this now with Imgrad Erasmus, a senior financial economist at Oxford Economics Africa, joining us now. Great to have you with us on the show. Now, it certainly isn't just African currencies that are struggling. We're seeing a number of nations, including the pound, globally, feeling that pain of course, the relentless strength that the dollar is showing right now. When we look specifically at African currencies, is it a reaction to a stronger dollar, or is it their macroeconomic weakness that is spurring the weakness in these currencies?
Well, unfortunately, it definitely is a case of both. As we've seen on the US side with the September FOMC meeting, they once again come out much more hawkish with the forward guidance. So the markets are now interpreting the forward guidance as another 125 basis points of tightening coming before the end of this year. So accordingly, we have adjusted our expectations, and now thinking another 75 basis points will be in November, followed by another hike in December, which is much more aggressive than we thought would have been previously. And this unfortunately has been the trend that we have seen with the FOMC. So obviously, when you do have that tightening of global funding conditions, it is definitely strengthening the dollar and vis-a-vis weighing on the African currencies. On the other hand, idiosyncratic risk is definitely coming into play. Now, since the Russian invasion of Ukraine, obviously we've seen this spike global commodity prices, and even with the benchmark prices falling back, especially when we've seen that crude, so the spillover effect is still playing out on African soil. So we've seen merchandise trade specifically for a couple of countries, but primarily the oil importers, coming under severe pressure. Hand in hand with that, we also have a intense focus on what will be probable debt restructuring scenarios that's playing out. We've seen Ghana obviously knocking on the IMF's door, and we have media reports and also credit rating downgrades last week that alluded to a domestic debt restructuring. And for quite a few other countries, including Ethiopia, that we know external debt restructuring is still very much on the cards. So the contagion risk there associated with is definitely a big factor to come into play. So unfortunately, it's not the one factor or the other, but it's a combination of both that's really creating this negative vortex. Now, adding on to this, high inflation differential to trading partners, unfortunately, just adding even more pressure on local currencies.
Now let's talk about the response to this, because analysts believe that we are likely to see a wave of tightening from central banks across the continent. But how do you assess the impact of the previous hikes we've seen so far, and of course relief measures, especially in Africa's major economies such as Nigeria, South Africa, and of course Kenya and Egypt? Have they been effective?
Well, it's once again a very difficult situation. Once again, if you're looking at Nigeria, very convoluted policy system, and therefore monetary policy cannot be just looked at in isolation. They still have very significant capital and other controls that is really distorting two-way trade. That's also why we've seen the divergence and the parallel market rate and the spot rate. We have a lot of pre-election spending. Obviously, this is increasing your Naira currency in circulation, and it's just distorting or emphasizing the impact that the dollar drought do have. So you do have those FX imbalances that's even more in play in some of these countries. Similarly, if you do look at Kenya, there's been quite a few foreign operators that alluded to increasing difficulty in trying to fill FX orders. So you're just looking on the system liquidity side. That is definitely a factor that is coming into play and really exacerbating the position. We also see a lot of this country knocking on the IMF's door once again, and it's a lot of challenge whether these countries, including Egypt, actually going to meet their external funding needs. So if you're looking at the broader picture, the role of monetary policy is unfortunately very small. And once again, monetary policy authorities really need to balance the pass-through effects of cost push inflation versus a very fragile demand side, and unfortunately also the risk of deteriorating asset quality. So it's a very fine balance that they need to strike in order not to kill the demand side even more. I mean, we've seen that most of the African economies, most across the globe actually, do have a lot of downside in terms of GDP growth. So it's definitely a very difficult path to carve ahead.
And that is quite interesting because it's not just Africa, but also globally, where we're seeing governments and policymakers having to dig deep into their toolkits. Some are tapping into their dollar stockpiles right now, such as Japan. Egypt is looking to include the Russian ruble amongst the currencies used in the country, which they hope will reduce pressure on their foreign reserves. What are your thoughts on some of these other moves and solutions that we're seeing them employing?
Yeah, there's a lot of pressure to try and broaden your current account inflows. On the one hand, there is a lot of pressure, obviously, in portfolio inflows. Once you do see a repricing of global risk premia, unfortunately, the attractiveness of the more riskier economies is unfortunately detracted by that. So trying to mitigate the pressure on the import bill, a lot of the countries, including Egypt, is looking at ways how to diversify. Now, the inclusion of the ruble is aimed at attracting tourist inflows, and it also will ease the settling of Russian wheat imports. As we know, Egypt is a very big importer of cereals, and it will continue to remain the case. And we've really seen the impact of this the spiking global benchmark prices really weighing on Egypt's merchandise trade position overall. Once again, have also seen that the IMF package is probably not going to be as big as we thought initially. Now, this is still being negotiated, but the question of whether a country is going to meet your external funding requirements, unfortunately, still there. So they're trying to diversify their sources, also investigating the issuance of panda bonds, etc. But overall, the question comes back on whether to restore fiscal sustainability and how to do that within a backdrop of a very hostile global funding conditions, as we see with the Fed going on now.
Well, certainly quite a tough picture ahead. We do have to leave it there, but thank you so much for those great insights, and thank you for joining us on the show. That, of course, is Irmgard Erasmus, a senior financial economist at the Oxford Economics Africa.